For those of you who haven't joined one of these webinars before, or people we haven't seen for a while, like Peter, BDC Partners. So we are a professional services business. We've got 4 parts to our business. We've got a property business, which Keith, who's one of our presenters today, is the CEO. We've got a law firm, a franchise recruitment business, and a performance business. We also have an investment business where we part own 4 different franchisors. So Bubba Pizza, Sinewave, Computer Explorers, and House of Golf. And then we're part of a group which we call BDC Collective, which has a number of different businesses, including Benjamin Benjamin with Richard, one of our presenters. Also Associated Projects, Gap Maps, Fordham's, Little Giant Finance, and Books 365, as well as Hatch. So a number of people in our community are all heavily involved in the franchising world. This is our second of our webinars this year. We've been presenting webinars and face-to-face events for about 6 years now on all different topics. So if you've got any topics that you're keen to hear about, let us know. Someone in our family of franchise experts and retail experts can surely present for you. As I mentioned, our presenters today, Keith Dawes, the CEO of BDC Property. Welcome, Keith. And Richard is the National Manager of Partnerships for Benjamin Benjamin Insurance. Welcome, Richard. Richard, you're on.
Helps if I unmute myself. Greetings, everyone.
You're going well. It's going well like me on the technology side of things. Just a question for everyone before we start. Is anyone in the CFE program with the Franchise Council of Australia?
Yeah.
Okay, cool. So Jason, this is you get points for this. So, and me, I'm in it as well. You in it, Richard? You need to step up, mate. Come on, do your CFE.
Next year I'll actually plan on it.
So we just need to send you a quiz, Jason, so you can get your points.
No worries. Happy with that.
So we'll send that out afterwards. Scott's in charge of that job. So today, we're happy for it to be interactive. I'm going to ask questions of the audience, so along the way through. But if you've got questions, there is a Q&A button to ask. Raise your hand. I can see a few people on the screen. If you've got your cameras off, if your cameras aren't, if your cameras are on, I see you. But for people that aren't on, yeah, just go through the Q&A function. Any questions before we start? We're all going to hear all about today property. It's insurance, risk, and insecurity in retail leasing. So all things property and insurance. So hopefully we've got some good discussions and people. There's lots of experience around the virtual room today. So keen to hear your stories as well and your comments. But Keith, we're going to start off on the property side of things. So over to you.
Fantastic. Thank you, Bruce, and welcome everybody. Firstly, I'm not sure whether Bruce said we were experts. I'm certainly not an expert in insurance, but certainly I think we've, as a property business, we come across some real kinks in the retailer's armory when it comes to insurance, and we've seen some horror stories, I think, in the past. So it's always good to be able to learn and get the best out of a bad situation, so the next client doesn't follow suit. So look, I'll go through broadly kind of where we see some issues and where we think retailers can probably be a little bit more in tune with what the market requires. And then I think Richard's probably the real insurance expert here. So anything I can't answer, I'm sure Richard will be able to. So look, I'll start off by probably saying, retail risk management as an overview. There's 4 or 5 bullet points there. But before I mention those ones, I'd probably say to you that most retailers will look at rent as the biggest risk when they sign a lease. And I think it's probably fair to say that it's probably not the biggest risk. Your liability and your obligation within that lease can actually be probably your biggest threat. And that's probably in a situation where if everything goes swimmingly when you sign a lease for 5 years and there's no dramas and you're making money and you're paying your increases every year and it's happy days, well, great. I think everybody on this call probably realizes that retail is not as easy as that, and that's not always the case. And it's only when problems occur that we see that maybe we were exposed somewhat, and in some cases it can be detrimental, and we have got case studies where unfortunately it's been detrimental for retailers in the past. So going back to these bullet points here, insurance adequacy, what does that really mean? You know, am I sufficiently covered? And what does that look like? Is that just based on what my quote said, and I wanted to get my quote down a little bit cheaper, so I kind of cut some corners? So that's really important to really understand what you need to be covered for. And some of these other slides we'll dig into that a little bit more. The lease in itself and the risk, well, I've mentioned that, you know, rent is one side of it, but the obligation and the liability in that is probably a very big part of the risk, the overall risk. Security requirements, we're finding that's moving. It's a real moving feast among different types of landlords. And when I say different types, what I mean there is probably, you know, an institutional landlord like your typical Westfield and vicinity and GPT, maybe versus a kind of a mom and dad type landlord that's got a smaller business. But by and large, we're finding that bank guarantees are probably you know, let's say moving north of where they were, and that's pretty much around that security piece. And a landlord will want to make sure that they've got a piece of meat at the end of it if things don't go so well. Another one again, which I think, and Richard will probably be able to talk a lot more about this, but I think business interruption is a huge part of the policy that needs to be in place, because the reality is when you have an incident, there is some form of interruption. And if your policy does not cover you for that interruption, it tends to maybe hold you back in so many different areas. And then obviously there's just basically, let's say, an under insurance risk. And again, that under insurance risk is probably, you know, you got your quote from your broker maybe, and, you know, you're finding things a little bit tough and you wanted to cut a couple of corners, and you said, you know, can you reduce it? And I think like everything else, you can always reduce cover, but, you know, what does it reduce within the policy that doesn't cover you then in the inevitability that maybe something might go wrong? So as an overview, I think there's some of the kind of key areas we'd like to maybe touch on and talk about, and happy to kind of dig into any of those in particular. Has anyone got any questions on any of those? Was everybody good? Okay. I think the this next slide, and I think this is the biggest misconception. And look, we've got a very different level of retailer on the call today. So, you know, some of the more larger, you know, mature traditional retailers probably have learned as they've grown. But, you know, we do see a lot of obviously new retail business owners and maybe some young franchisees coming in to the market that you know, probably have a little bit of a misconception about what's covered under the landlord's insurance versus what's covered under their own. So I think to be very clear on that, I'd say to you, the landlord is the most selfish person you're ever going to deal with when it comes to your relationship. That they will care for themselves and themselves only. And pretty much you're going to be left to cover your own devices when it comes to all different aspects of protecting your business. But ultimately what the landlord will protect is his building and his structure. Now, what does that mean? Well, that's you know, that's your walls, your roof, and any structural elements within the center. Obviously, then you've got the common areas, which are the shared spaces and car parks and public corridors. And then the landlord would always make sure, like we always do, that, you know, you've got landlord liability. And so he covers his own legal exposure. Now, from a retailer's perspective, there's probably, this slide is probably a little bit light on, but there's loads of different things you could add to this. But ultimately, what the first port of call will be from an insurance perspective will be the fit out and the fixtures and equipment, let's call it. And then you've got your stock. And then you've got your public liability and you've got your business interruption. Now, it doesn't necessarily need to be in that order, but again, what we've probably come across where challenges have been met by retailers down the track is that none of these areas, probably outside of public liability, which is one that is dictated by the landlord in terms of what number you cover yourself for, the rest of them are a moving piece. And I think, again, Richard could probably allude to this fact. But we find that retailers probably don't cover themselves to the level of cover that they need. And there's probably a few different reasons for that. But if we look at a situation where we have a fit out, retailers in this current environment are probably spending anywhere between $1,000, $2,000, $3,000 a meter to build a store. Now, yes, that's amortized and depreciated maybe over the term of the lease over the 5 years. However, to replace that fit out and with the ongoing cost increases between labor and materials, that always gets out of sync, or that can get out of sync very quickly 2 years into your lease. Stock replenishment, again, is something that we've seen whereby, you know, we know of retailers could carry $500,000 in stock, but might only have the policy covering half of that. And if the stock gets damaged in the event of a flood or a fire, or even just water damage and leaks, which are very common, you know, not having the stock valued at its full kind of cost price value to be able to replace it for yourself is a big issue. As I said, public liability and building insurance interruption, you know, the business interruption piece, I think, is a really, for me, and I'm really interested to hear what Richard has to say about this, but I don't think retailers where we've seen that have had problems over the years, the business interruption has never been a major part of the policy, and I think that's really vital. So, I mean, if to maybe touch on that a little bit, you could probably go back to 22 when you had the floods and you had assets in Lismore, like Lismore Square, and I think it was Lismore Central. And then you had Toombul in Brisbane. So they got hit dramatically by the floods. And in Toombul's case, you had Mirvac actually close the centre down and bulldoze it because it just wasn't viable where it was located for them to go and get reinsurance and for the retailer to do the same. But that business interruption period, you know, there was so few retailers that were insured for that. There was no way they were ever going to get back on their feet. So it's a big one, I think, to look at. Happy enough just to jump on that next slide, Bruce.
Did that change?
Yep. So, okay. So in the event of let's say we've got a scenario where the shopping centre's got a flood or a fire, and let's say it's a major incident, or it's maybe even just a leak in the property. What will the landlord do? Well, you know, in their experience and based on the cover and the policy and how your lease is worded, they'll just rebuild the shell. You know, and this is probably where this misconception comes into place for a lot of retailers. They think if something is to happen, you know, and let's say it's even not a major flood, but it's a leak in the roof. Well, they say, well, the landlord, I don't own a roof. The landlord owns the roof, so, you know, I'm going to be covered. Well, that's not the case. The landlord's expectation is that you've got your fixture suite and you've got your stock and you've got everything else covered within the policy, and their obligation is just to fix the roof. And in their experience, when that happens, it can be very slow actually, and very and very tedious to get done, because they'll come up with all sorts of different excuses as to where the leak is coming from, and they can't find where the leak is coming from, and we've seen some really big dramas there. In fact, I can give you a story. We opened a brand new Adidas store in Logan last year, and 2 days in, after spending north of $800,000 on it, on just a fit out, that was excluding the stock, we had a major leak, and dealing with the landlord in that situation was just very tiring and very weary, and we had to take action ourselves to just basically put our policy into place straight away, because waiting on the landlord we knew was going to be something that was going to take some time. So the retailer will basically replace everything that belonged to them. You know, so what's the landlord's is the shell, it's the building, it's the common area. Everything inside your tenancy is physically yours. Another area which again probably doesn't get considered by every retailer, and I will premise that I'm not talking about everybody, but a lot of retailers won't have that wages and rent and let's say gross profit covered under the policy. And as we all know, on this call, gross profit dollars is what it's all about, and it's what pays our way. But you know, when you've got staff that are probably out of the store for a period of time during the leak or the fire or whatever, and there's an expectation that we as a business will still have to pay them. And the landlords, you know, our obligation to the landlord, and we saw this during COVID, they still want their rent. You know, landlords will not at any time, whether in an economic meltdown or whether, you know, they've got a building site on the asset, or it doesn't really matter what it is, you know, they will want their rent. So, you know, you've got your wages, you've got your staffing, you've got your rent, and that all needs to be paid for. So it's a big part of the policy that I'd be saying to retailers, make sure that there's a level of those areas that are covered to some degree that doesn't leave you overexposed. The last one there, I suppose, the underinsurance, and I would say Richard probably sees this probably more than ever. And this is probably just purely around stress in running a business and starting up a business, or maybe just, you know, overheads increasing year on year, where, you know, you're trying to cut corners and overheads, and you look at your insurance policy and you think it won't happen to me, and you cut corners. And I think, again, you know, we have seen situations where that has been very detrimental to retailers. Just before I move on, is there any part of any of those kind of topics that anyone would like to either discuss or, you know, look for more information on, or anyone got anything to add to that?
Or examples? Richard, have you had an example where you've had the claims on where people?
Yeah, again, I guess the example that Keith gave is just recently around Logan is one that we've seen. We had, again, a franchisee from a particular business. There were a number of policies that were identified in the lease agreement that they were advocated or encouraged to take out, actually mandated as part of that lease agreement, so they weren't in contravention. They only took out one of those, which was the public liability, for whatever reason. Again, at a point in time, there was a significant leak, there was significant damage. They didn't have any insurance in relation to their assets, to their stock, or anything else. And that was, you know, a real gunfight as to who was, you know, what was going to happen to the business, what was going to happen to the staff, you know, the ongoing concern for the business and so forth as well. So it's one of those things, as Keith said, you know, what are the obligations from the landlord versus the obligations that fall on behalf of the retailer. The one that I just want to mention quickly, if I can, underinsurance has been mentioned on a couple of occasions. For those that aren't aware of it, there is actually a formula that insurers use when it comes to underinsurance. So I'll give you just around numbers one, but the principle applies the same. So let's just say there was a rebuild cost of $1 million. That was going to be for the fit out and everything in regards to their operation, and they had insured themselves for $700,000 as a value. So that's 70%. When the claim is worked through and the insurer does their due diligence and finds out that it is at 70%, that is considered to be underinsurance. So pretty much anything that, you know, a lot of policies will have a top up of maybe up to 20% in value. But if you're deemed to be underinsured, and 70% is certainly considered underinsured, you won't get $700,000 as a payout, being that 70% of that value. You get 70% of the 700,000. So if you had it insured for 700,000 as a net value, they'll apply a 70% formula to that, which means if the refit cost was $1 million, your payout will be just over $500,000. So you're effectively going to be $500,000 short. So there is a methodology and a formula that insurers use when it comes to underinsurance. Hence why we do encourage everyone, as Keith said, that, you know, things are certainly tight for some businesses. And businesses are looking at, you know, how do they impact their premiums in their favor and so forth. Underinsurance is one thing that we don't recommend. There are other options available to businesses to be able to look at how they can streamline their premiums and so forth. But underinsurance is one that I definitely wouldn't advocate for that reason, because it can leave you in a very big black hole.
Anyone else? So Jason, what about at Bakers? Any dramas around not knowing what was insured or explore and develop now?
Yeah, and I think the one benefit with Bakers and the example there was hoping or asking the franchisee to take on the appropriate levels of cover. And I think the one thing to the credit of Bakers is one centralised policy that covers all franchisees. It's certainly robust and also gives us some level of clear view on the appropriate actions when something does occur. That was so if we had, as an example, in Toombul was one of the stores that we closed in Brisbane as well, and Lismore, the ability for us when I was at Bakers internally to react collectively. We knew what the policy was, when we should be contacting the insurer, what potentially costs the franchisee was going to be up for if there was any gap there. But I think that was the one benefit of owning the entire process from the top down, was setting the tone on what was expected of everyone. And
do you do that explore and development now?
So we're going through a process of, I think, just reviewing. I'm 9 months in here now.
Yeah,
Chris is on the call as well. We're going through a process of renewing and looking at all of those processes at the moment. I think the one difference, and we've got to be fairly honest within early education, is the public indemnity and a lot of the other compliance insurance risks. So for us, the underinsurance can't occur because of some claims liabilities can go 7 years in reverse. So we're going through that process now. I don't know that we'll end up where we're dictating down, but we've certainly got operational structures to say we won't improve insurance and change of insurer by our franchisees unless they've run it through us. So we do control an element of that as well.
Yeah. Peter, what about you and some of your different roles? Is there being involved in managing to ensure that there's no gaps in the insurance processes?
Yeah, look, not so much the finer detail of the individual franchisees cover, but more so the classic fight with the landlord on aircon, leaks, break-ins, that sort of stuff. You know, what defines the shop front, what's the ceiling, who's responsible, those sorts of things like that. So yeah, that's just ongoing, of course.
Yeah. Keith, am I on the right slide?
Yeah, you are. Yeah, and that, Peter, actually, that's an interesting one, because honestly, I think as retailers, aircon is one of the biggest banes of your life in any shopping centre complex, because it's very much hands off from the landlord. You know, in respect of even just getting the right feed into your tenancy and getting the right temperature control versus it not working. Or, you know, we've got situations where, again, depending on the type of asset, you know, you're taking over an existing aircon system that they're asking you to service and to, you know, to pay for and to do everything. And then, you know, it's not your property to take away at the end of the lease. So, yeah, we always advise very clearly on, you know, how to handle those situations, particularly if it is more of a mom and dad type landlord and, you know, there's an aircon system in place that you know, that can look to be just on its last legs, but the expectation is that, you know, you've got to service it, you've got to repair it. And, you know, where people sometimes miss those little things, they can be quite costly, you know, because, you know, you could be repairing it for a while or you could be having to replace it completely, and it's on you to do that. And we've actually got one of them at the moment in Port Stephens with Totally Workwear, where we're renewing a lease. And lucky for us, we've had a change of owner in the building and the solicitor has bought it. And the heads of agreement came out with probably about 10 different changes in relation to a personal guarantee was one. And sorry, I'm not going off point here, but in his case, he wanted all these extra things, but he wanted the aircon service by us, and not once a year, but 4 times a year. And at the end of it, when our lease expires, we can't take it away. So it was like, you know, how is that cricket, right? So, you know, you get a lot of issues like that, and you know, going into it, you just need to understand that could be a problem, and if you're aware of it, I think that's half the battle. But leading nicely then probably to the next slide, you know, does the landlord compensate the retailer when there's an issue?
Yeah.
And, you know, that big black box says rarely, and in our experience, you know, I really mean rarely. And then when it does, it generally means getting Bruce and the law team involved because they just cannot see sense. So, and look, in every situation that I'm talking about today, it will depend on the small wording in the lease. But by and large, I think it's very fair of me to say compensation is rare. Specific wording will determine whether, you know, you've got them on the hook or not. But believe me, guys, when I say to you, you know, the majors leases now, as we all know, probably are just so sophisticated. You know, it's very difficult to walk through them. And when you look at Centre Group, for example, you know, they're not doing a traditional kind of letter of offer and you kind of go through your heads and you pre-agree everything before a draft lease. They're going straight to a disclosure statement, and they're trying to, you know, in my view, they're just trying to hide stuff. They're trying to kind of get stuff that people maybe might miss. And, you know, some people, I had a retailer we took on recently said to me, I didn't know you could mark up a disclosure statement. You know, so is that why Centre Group use it? You know, I'm not so sure, maybe. But in relation to the compensation, you know, the negligence piece obviously is key to that as well. You know, was the landlord actually negligent? You know, we've got a lot of situations whereby retailers might have a small leak in the tenancy, and they're informing centre management, they're informing the retail manager within the centre, or they might even know the centre manager personally, and they're informing him, and nothing gets done about it. You know, and then all of a sudden, you know, you get a big rainstorm, or you get a month's rain like the Gold Coast did last week in the day, and you've got a major shit fight on your hands. So depending on, you know, how negligible they are, will determine whether you can get compensation or not. But again, probably another clause in this disclosure statement will be, you know, their insurance will exclude consequential loss. They'll do their best to make sure that, you know, you pay for everything and they pay for nothing. And it's got to be something that, I suppose when you're signing a lease, that you're very aware of that potentially, if that small wording is in there, you know, you're not exposed to that. And then that last but not least is probably the abatement piece. And for us as a property business, that's probably the first lever we will pull in those instances, because, you know, we're supposed to get quiet enjoyment, we're supposed to have a fully kind of sealed building, and you know, all of those beautiful things that they tell you they're going to provide you, but you know, that's not always the case. So yeah, so the abatement piece is, you know, common, where we would probably you know, now we're very careful how we do that, because you don't want to be within breach of your lease either, and not paying your rent is one of the reasons you can be held in breach. But we try and tie it into obviously the negligence piece, you know, the communication regarding maybe the issue that we have identified that they didn't act on, and then hence we're in no other position but to maybe self-abate, or to at least seek an abatement. Self-abatement is probably another podcast on itself, or sorry, a webinar on its own. But you know, I do know of one or two prominent national retailers that are self-abating in a Westfield asset at the moment, but it's purely around the actual asset's performance. But I won't get into that now. But yeah, an abatement. I mean, look, sorry, we're abating on a tenancy whereby a retailer sits right outside the travel letter, and travel letters have been broken for what we feel is longer than expected, and the traffic passing the door has dramatically dropped off. The closest lift is probably 500 meters away, and we are in a situation whereby we requested an abatement, went on deaf ears, and we have now self-abated on that one. So we have got the landlord's attention on that, and we haven't been put in breach, and I doubt that we will be.
So we're going to just change tack a little bit now on other risk factors, but we're going to come back to insurance. So I know personal guarantees and bank guarantees, and there's a whole range of different things. You know, it's communication and managing risk.
Bruce, could I maybe just ask you, just maybe to kind of keep, there's a couple of things, there is a couple of slides just on insurance down a little bit further, which we mentioned around, where are we now? Let me see it.
Which one do you want?
Yeah, sorry, I'm just looking here. I thought we had one about just who's noted on the policy versus yeah, okay. So do you see that release there where the mortgagee must be noted on your policy? I wouldn't mind just touching on that briefly. It's a couple of slides down. Sorry, just on this. This is something that, again, we've probably seen creep up a little bit, where landlords have actually, they've asked a retailer to be noted on the policy. And we've had an incident recently with Charter Hall at Waverley Gardens, whereby the mortgagee also wanted to be noted on the policy. And initially it kind of startled us, because we hadn't been asked for that. We hadn't been asked for it in probably the last year or two, and we thought it was a little bit strange. But basically the situation there would be, you know, the bank or the lender to that actual shopping centre will obviously have a loan against it, and they do ask to be noted on the policy, and it generally will be, it'll be the landlord, the mortgagee, and in most cases the centre manager. So that's probably something that's quite common, but it doesn't, what it's saying there is it's not adding them as an additional insured. So it doesn't operate or control your retail business. It's not exposed. You're not exposed to day-to-day liability. But probably what it does is it protects the lender's financial interest, and it'll support the landlord's financial obligations, and probably more importantly, what Charter Hall explained to me in that situation was with that, it just gives them visibility on the cancellation or elapsing of the actual policy itself, and then it does reduce the uninsured's exposure. So yeah, sorry, Bruce, that's probably one that was mentioned there. Yeah, happy for you to go back up to the bank guarantee piece. So in relation to, I touched on this at the beginning, I think bank guarantees and personal guarantees traditionally have always been, let's call it, bank guarantee might be anywhere from 3 to 6 months, but we're really finding that that's changing lately, and it does depend on the maturity and probably the covenant of who's signing the lease. But we're finding that retailer or landlords are taking less and less risk and asking for more, and it's an absolute real drain on the retailer, as we know, and Richard's going to touch on the bond piece later on as potentially an alternative. But from our experience, predominantly over probably I'd say the last 12 to 15 months, they're coming out with 9 months, looking to probably settle on 6. And we're probably starting anywhere from 1 to 2 to 3 months. But established businesses are still, depending on the asset and depending on the vacancy rate, landlords are being very bullish in their requirements. So when it comes to the bank guarantee versus the personal guarantee, we always advise that we probably prefer to pay a little bit more on a bank guarantee than paying a personal guarantee. We don't have one client on our books whereby we've allowed them to sign a personal guarantee for a lease. It's just not something we believe is the right thing to do. And irrespective of the maturity of the business or how healthy their balance sheet might be, it's just something that you don't always have to do, and you will get around it, but it needs patience and it needs probably a little bit of expertise dealing with the landlord. So my big call out today on this call, if no one takes anything other than do not sign a personal guarantee, because you won't have to probably get the deal done. And if it means you can't get that particular tenancy, you know what? You're safer to walk away and probably find something else in the trade area or in the centre, or a centre that's an adjacent centre to the asset.
We've got a couple of I might throw out to people there because we've got some brands on the audience that are newer brands, and I don't know, Dean, are you there from Nautical Bowls? It looked like I saw you before.
Hey, Bruce. Yeah, mate.
Really? So is this like, obviously your brand, you're still, under 20 sites. Are you finding that personal guarantees and long bank guarantees when you're negotiating leases is happening?
If they want personal guarantees, we walk away.
Yeah.
I'm just not putting myself or anyone else on that. A site like Harbour Town, we had to take on the head lease, which is fine because it's a bit of protection and we know it's a good class asset to be in for us as a brand. But also there's no personal guarantees. It's just a 3-month BG anyway.
Yeah.
From the franchisee on a sublease.
Yeah.
Yeah.
Natalie, is that something, what about your leases? Are the franchisees all franchisors?
Yeah, all franchisors.
Yeah, so are they asking for personal guarantees from the franchisees? Because I know you take some leases and franchisees take some.
Not personal leases, not personal guarantors, no.
Yeah. And Pete, you're able to get out no personal guarantees for the large brands you've worked for, I'm assuming?
Until recently, last experience with Subway, and they've gone internationally in a new strategy of taking themselves off leases and franchisees having to come on board. So we're stuck with some of the bigger landlords asking for bigger bank guarantees, but also personal guarantees as well too. Yeah. So that's an ongoing fight.
Yeah. So Keith, I think that's where the franchisors take them and they're trying, like a few brands we're working with, the franchisor is saying we don't want to take the leases anymore because we had a couple of experiences recently where franchisees have decided to leave the country, and franchisors are left holding the baby. And there's so
That's
Yeah.
a tough one. Yeah, look, you know, because the analogy there too is like an assignment. You know, it's kind of like the landlord gets his piece of meat at the beginning, and then changing the goalpost for him is not what he wants. So, in actual fact, going from a corporate to a franchisee, irrespective of how well they're doing or how mature their business is, and they've had other businesses and all that history, it's not a good look for the landlord. So they are tricky situations for sure. It's hard to it's easier to go the other way, but going backwards is it's difficult.
Yeah, so I think in my experience, franchisors are able to negotiate out of bank guarantees, even if they're not that big. Like you might only have 10 or 20 sites, but when it comes to franchisees holding leases, landlords are less flexible, even if it's either a new site or being transferred from a franchisor.
Yeah, they'll still want, but even from a franchisor perspective, they'll still want their genuine, let's say, bank guarantee. It's probably just a personal guarantee that they're not as concerned about. I think everyone's gonna. I don't think we've ever done a deal where we haven't got a bank guarantee in place, but personal guarantees certainly are. And look, they try it on. They'll always ask, and it's probably and they catch some people on the hook and off guard, and some people think again there's no other way and there's no other option. But I think you just need to be very wary of. I mean, the Harbour Town's a good one. Like when you're in an asset that's mature, it's proven, and your business model looks strong and secure. Well, then there's a level of risk with all these decisions that you make, but. Yeah, personal guarantees. We just, and look, we're going through with House of Pickle at the minute, which is on a very strong, aggressive growth strategy, but it's only a new business. It doesn't have a balance sheet, So I'm having to kind of structure leasing agreements whereby we're starting off with 9 months bank guarantee, and after year 1 we go to 6, and then after year 2 we go to 3, and then like that's a relatively comfortable position for some of the landlords, and so far we haven't really tested that yet with Westfield, but we're about to. But certainly in the larger format boxes and some of the companies that we've dealt with there, that's been acceptable, but it wouldn't have been acceptable otherwise, because they love the business and they thought it was a great concept and they think it's probably gonna trade, but they still just don't want to take the risk. And don't forget too, some of the risk on their side is also they're probably giving us a bit of incentive, so we're probably getting a bit of cash, and you're probably getting a bit of rent-free, or you're getting a combination of the two. They're probably making changes to the tenancy. They're probably splitting it. They're probably costing them to build walls and put in extra power boards. So there is a little bit of expense at times. So you can understand maybe why they might feel exposed, but you can't work through all those different scenarios, and that's probably one lever we can use with a landlord to maybe give them comfort outside of a bank guarantee that's 12 months maybe for the term of the lease, which could be 5, 6 or 7 years.
Yeah. Do we want to jump to, before we get to Richard and insurance, we've got about 20 minutes left, so is there any other of the risk factors we go through?
Oh, look, I think no. I mean, look, I'm happy to hand over to Richard now, but probably just that piece in actually signing your lease. As I said, like the rent is one aspect of your concern in terms of what that looks like in year 5 versus what it looks like in year 1. But would be very mindful with the institutions that get the experts in, get a lawyer in to have a look at it. That they are getting more sophisticated, and ChatGPT or Claude or any of those language models are not always the answer to throwing your lease into. We still, and I test it all the time, believe me, and we see errors. It's only when you notify them of the error, they go, oh yes, you're right, and then they'll pick it up. So I think just signing a lease, understanding that the obligation and the liability is not just in the rent, it's the get out clause if the shit hits the fan. And look, sometimes unfortunately it does.
Yeah, no, managing risk along the way, because if you want to get out or sell the business or transfer, as always, you are some little gems. Richard, do you want to let me know which one do you want to jump to, and we might come back to some of that other stuff if we get time.
Sure. I was
16. Is that what? Do you want to keep going?
I was going to say, considering we've been talking about bank guarantees, I might
jump straight to it. Yeah. Okay.
Jump into that one.
Which one's that one?
So for those, there we go. So for those that are interested, there is an alternative in the market that's available to the traditional bank guarantee. It's actually been a product that's been available overseas for several decades now, and in the US and in other parts of the world, it's actually the norm, as distinct from what we experience in Australia around traditional bank guarantees. So a lease bond or an insurance bond, a tenancy bond, which whatever you want to call it, provides exactly the same protection as a traditional bank guarantee from the landlord's perspective. Once it's established, it's unconditional, it's irrevocable, it pays out on demand, exactly the same as with a traditional bank guarantee. The triggers for a claim are exactly the same as a traditional bank guarantee. So there is actually no differentiation from a landlord's perspective, other than the digital product is actually probably even more secure. It means that landlords don't have to worry about holding on to, hard copy certificates and keeping them in a safe somewhere under that what if scenario. And particularly if they need to go and make a claim, they don't need to worry about taking that certificate back to the branch of origin where it was written, because, what happens if that branch is closed down and is no longer there? So there's a number of different scenarios that could be of an impact from a landlord. But from a tenant perspective, as I said, it provides exactly the same protection, but it provides greater flexibility. So there's no need for the retailer to come up with the cash that's got to sit in that bank guarantee. So if there is a claim that is made, the policy will pay out on that claim, and then the policy will seek recovery from the franchisee or from the tenant in that particular space, from the retailer. But it means, so it's important that the person taking out that lease bond is in a good financial position. And so this is a fiduciary product. There is no personal guarantees required or anything like that. It's purely and simply based on the financial performance of the business. So it's not really applied or taken up by businesses that are brand new, or certainly probably less than 2 years in operation. But it does mean that if somebody's been in business for a couple of years, they've got the financials to show that, there is a good asset to or debt to equity ratio, that they are paying themselves, that they are holding onto profits within the business as well. They will meet that threshold, and it means that for either a new lease, it means that this particular product can be taken up. It can also work for existing leases. So if
when you say new lease, so initially you said you have to be trading for 2 years. So yep. Most of the people on the call are franchisors. So when you say if a franchisor has been trading for 2 years, but there's a greenfield site for a franchisee, is that going to have to trade for 2 years?
It depends on whether it's the head lease is held by the franchisor or by the franchisee. So in a business where the franchisee holds the head lease and they may be moving to a new site, but they've been in business for a number of years, their financial positioning will be taken into account. Then, especially if it is a new greenfield site, they will want to see a business plan and associated with that as well, but their past performance and their operational expertise will stand them in good stead. If the franchisor holds the head lease, then it's far easier from that perspective. And what we've seen with some franchisors that have held the head leases, you can set this product up so that it can cover a number of different sites all under the one agreement. Okay. And you will only draw down, so you can actually establish a facility that could be worth far more in value than the leases that you've got at the moment. So it allows scope for growth. So you don't have to get approval every single time. You can get some pre-approval in relation to that. And you only draw down in relation to the fee that is paid once you've actually opened up new sites. But because it's actually then taken by the performance of the financials for the franchisor, it actually is a lot simpler and easier in relation to doing that.
So have you seen franchisors take out an insurance bond where the franchisees all contribute to the premium? Yeah,
exactly that. So what they'll do is they'll sit there and go, right, for all of the 20 sites or 50 sites or 60 sites or whatever it is. Here is the overall premium for the policy, which typically equates to about 4% of the value of the overall guarantee that's required. And then they'll amortize that against the individual franchisee. So they'll say your contribution to this facility is X based on, you know, the guarantee that was required specific to your site and the contribution that it made to the overall facility. But it is, it certainly means that for individual sites, you don't have to worry about, you know, having cash tucked away for an extended period of time that just sits there in somebody's bank account and doesn't even earn interest from your perspective. It means that you've got access to that cash to invest back in your business. So there is a number of benefits, both for landlords, but also for, you know, franchise or franchisees, retailers in this particular space as an alternative.
Yeah, so national, like retailers rather than franchise business, it's a great product. And then, but the franchise, for a franchisor opening greenfield sites where they take leases, the franchisee, it could help them not get a bank guarantee and also personal guarantees.
Absolutely, there's no need for personal guarantees, but again, the franchisor in that space would then just separate that cost out back to that individual franchisee. And that would be their contribution in the same way as a franchisee might make a contribution to an overall marketing fund. The same principle would apply here.
And has there been a bit of negotiation, Keith? Have you had to negotiate for clients on behalf of to try and replace existing security arrangements to put this in place?
Yeah, yes to the first part of the question, but not to replace it with a bond. But yeah, in terms of just moving liability around and bank guarantees, yes, it's quite common, to be honest, because when you've got an assignment, you know, most cases you're signing the lease and the agreement that's already in place. But you know, in a lot of cases, landlords, you know, look at the covenant that was there prior, and the incoming assignee needs to be as strong, or if not stronger, or they won't take the risk. I mean, speaking to some of the team from Pack Fair in the Gold Coast last Friday, you know, they had one of the best performing cafes or restaurants in the an all-day restaurant in the asset. Was an assignment, but it went to VCAP because, you know, the existing business was doing, you know, I think they said it was doing like $12 or $14 million a year, and he was looking to assign it. He was selling it for some, you know, I think it was over $2 million. But the assignee was inexperienced within the cafe, let's say, restaurant industry, and they just felt that, you know, they were going to have a shit fight on their hands. And that particular one ended up going to VCAT. So yeah, look, you can have situations whereby, you know, whatever you agree to initially in a lease, irrespective of your future term play to either sell your business or get out, you know, if you're putting the lease in the head lease in the business's name, you know, it's kind of what you buy is what you sell, right? You know, if you hook in too hard and give them what they need at the beginning, on the back end when you're trying to get out and assign and sell, it can be really difficult. So yeah, but you know, every situation is probably a little bit unique, Bruce.
Yeah.
Bruce, sorry, just if I can, and just as an example of this product, we've had situations where we've had head leases being kept by one entity, and there's been, you know, over $1 million in cash that has gone back into that business through swapping out the traditional bank guarantees with this particular lease bond. So, you know, it's been the simplest and easiest way to get cash back into their business so they can invest into their business, because it's cash that's there. It's just sitting there idly. So the ability to be able to swap out at a point in time has worked extremely well for them.
Yeah. Okay. Is it Kyle, are you from a fitness brand? I think is it an industry specific thing?
No, so it works across all. The only restriction we've got is that we've got probably a couple of major landlords like Centre Group and QIC that are still not going down this path for whatever reason. But pretty much every other major landlord, private equity, you know, mum and dads that are, you know, landlords on you know, strip shops and so forth. Once they understand this product, they're all accepting it. So Vicinity, for example, has accepted this as blanket, you know, from their perspective.
Sorry, Kyle, you're on mute before?
Yeah, I am from Fitness Brand. I'm head of property with Fitness Cartel and Merce Wellness. New role, but I've been familiar with e-guarantees for a number of years.
Yep.
5 or 6 years ago, I was consulting to Barbecues Galore, and we looked at swapping out e-guarantees, swapping out bank guarantees with e-guarantees for exactly these reasons. We went down the track. I think at the time they were demerging from Amart, so we had to pull Amart off their leases anyway. So we used that opportunity to get e-guarantees implemented or into the lease as a possibility down the track.
Yep.
So I've been familiar with it, and the same situation applies now. We do have a lot of cash set aside in a brand that is as a growth mindset. We have 18 sites and going to grow to 60 in the next 3 years, and that's a lot of cash that could be put towards that growth rather than sitting in a bank somewhere. And I know our CFO is constantly going back to CBA to refinance capital growth and stuff like that, and something like e-guarantees is probably the main reason I sat in on this presentation. It's very significant and good opportunity, and glad that e-guarantee have done a lot of the groundwork to get landlords to accept it, to the point where landlords are starting to realise that it's a better product for them in the event that they ever have to call on it.
Yep.
So,
no, exactly right. They can be paid out in 24 hours. It's as simple as that. Everything's done digitally. Everything's online. So there's a value proposition from both parties. Just in
the challenge for us is just going back to the existing leases and trying to get them to accept the changeover, and seeing the requirement for accepting an e-guarantee in a offer to lease is often one of the first stumbling blocks to overcome. It's just new to them.
Yeah, it's ignorance. A lot of it's ignorance, I think, isn't it, Kyle? But I think like we just did one lately for commercially. There was an office or an industrial warehouse. We did a deal for House of Golf, and it was quite a large property. Anyway, we went down the negotiating road like you do, and we kind of used it as a bit of leverage. But in the end, at the beginning, they said absolutely blanket. It was a no. But we kept pushing that boat, and it was purely just in the end they admitted it was pure ignorance. They didn't really realize how it worked, and once they did, they were very accommodating to take it on.
One of the other benefits is the insurance bonds players are happy to go to the landlords and sell that product to them. On your behalf, so they'll go and have the conversation and get the approval for you.
That's a good segue, Richard. I'm going to throw to you for this. We've got a couple of minutes. One more slide there.
Look, might go with bring two slides into one. So I guess one of the challenges for businesses in general is that sometimes, again, they'll look to try to save a few dollars, and we absolutely understand that. In today's environment, and quite often they'll jump online and look to arrange that insurance themselves. I guess one of the key considerations is I'll refer to as the missed opportunity. There's over 160 insurers in the Australian market alone. They don't all do exactly the same thing. So you'll have some insurers that will just want to insure particular industries, and there are some insurers that will just want to insure particular, an insurance policy. That's one particular type of policy for one particular industry. That's all they want to do. Now, those insurers will actually be quite aggressive in the market because they want to get market share. If you're going online, the vast majority of insurers in Australia don't work through online that allow business owners to engage with them directly. They will only work through brokers. So if you're not using a broker to actually go to market, to identify the market, who are the right insurers, what are they offering, making sure the structure is right, you can actually be doing yourself a disservice purely and simply just by not being able to engage the right insurers that are out there in the marketplace. And so I do encourage all business owners that that's one of the key value propositions that a broker can do, is can give you far better representation and far broader access to so many more insurers and to negotiate better outcomes for you than what you might do just by pressing buttons online.
Thank you. We have 2 minutes left. I've got one. If anyone's got one last question, or Keith, if you've got a closing comment you'd like to jump in.
No, not necessarily, Bruce. Probably just to say that, yeah, your obligation and your liability is not just in the rental number you're signing on your lease. There's a lot more to probably consider. And I know you'll send this presentation out to people. There is a bit of a checklist there. Yeah, for me, the underinsurance and the business interruption is probably something. They're two key things that we just see retailers getting bit by badly when unfortunately the roof does cave in.
Yeah, there's the checklist in the yes, you're right. We will send the slides around. We have recorded it, as you've seen. So people, there's people that didn't jump on and are listening later on. So they'll get that, and they'll also get the slides, so they'll get the checklist as well. So I'm just going to flag one last thing. Firstly, thank you to Richard and thank you to Keith for your presentations today. Very insightful. Thank you for everyone for joining today, and for all the people that I jumped on and asked them questions that jumped in. Thank you very much. It's always better, we find, when it's a discussion rather than just a stand and deliver presentation. It's great to hear from the brands that are joining. And in the last minute, we run these every couple of months. We've got one in July coming up. 28th of July is my birthday, so I want to make sure that, Richard, you get a cake for me delivered down to Mount Eliza. So for my but it'll be very exciting here. We're going to have a franchise recruitment topic next time round. So
how many candles, Chris? Bruce, how many candles?
Yeah, 50, it'll be real exciting. 56 this time round. So yeah, looking forward to presenting a webinar on my birthday with Dave and Luke. So Dave, if you're there, make sure it's a good one. Thank you, everyone. Thanks a lot for joining, and stay safe, and I'll look forward to seeing you next time around.